If you're like me, you're seeing a lot of calls and predictions for a market correction coming right at us, which can definitely provoke some anxiety. Now, we've heard these types of things before, ever since the dramatic bounce back in stocks after the plunge last March, where we heard that stocks recovered too fast, too quickly, and while we had some pullbacks, we really haven't had anything too major at this point. So the big question now is it really happening this time? Today, I'll look at the 3 big reasons why correction is being predicted, plus I'll throw in a couple of other ideas to support the notion of an impending correction, but why I think that these may not be quite as important. And then I'll share 5 strategies on what we can do to prepare for a possible correction. So let's start with the headlines, and they are everywhere. Investment banks turn sour on U.S. equity outlook. Morgan Stanley downgrades U.S. equities on growth risk. Citigroup says positioning sets up market for steeper fall. Deutsche Bank predicts a 5 to 10% stock market correction before year end. Stocks could be due for a correction of up to 20% by fire or ice. Wow, does that one sound cataclysmic or what? Alright, so let's take a step back from the emotion that these headlines are invoking and try to look at this more rationally. And first, to make sure we're on the same page on what we're talking about here, a market correction is defined as a market decline that is more than 10% but less than 20%. Now, anything more than 20% is a bear market, like what had happened at the onset of the pandemic, and anything less than 10% is usually just termed a pullback. So while there's always someone out there calling for a crash or a bear market, most of what is being predicted today is less severe than that. And remember, just because there's a lot of people saying a correction is coming, nobody can say that with 100% certainty that it will happen. However, when a lot of people who do this for a living are calling for one, it makes sense to at least be aware of it. Now, nothing in this video is telling you to go out and make any rash decisions and moves, but just to make sure you're doing your due diligence and being prepared. Alright, so before we talk about strategies to better position yourself if a correction happens, let's look at 3 big reasons for these predictions and then, as I said, a couple of other ones that are floating out there as well. Number 1, high valuations. Now, this is always the most common reason why a correction happens, and this is a big reason that many firms are calling for a correction. Credit Suisse says it maintains a small underweight on U.S. equities due to reasons such as what they call extreme valuations. Valuations are measured in a lot of different ways, with most citing the PE or price to earnings ratio. Now, using that measure, this really isn't new because for most of the past year, valuations have been high, but they were high with the expectations that earnings would grow faster than expected. And up until now, almost every quarter, actual earnings were beating expectations. However, that does seem to be changing now that household companies like Sherwin-Williams and PPG Industries have issued third quarter warnings. And even the travel companies who earlier in the year were raising their expectations are now starting to offer warnings as well. And while we're looking at the whole of the S&P 500 in general, as most people do, it's interesting to see that a lot of individual stocks have already fallen into correction as investors are looking at leveling valuations of price to earnings ratios. And according to Bloomberg, about 90% of Russell 2000 stocks have already fallen into correction. And then back to the S&P 500, Morgan Stanley has revealed that the average stock in the index is already down 10% from its 52-week high. The S&P has been boosted by the weight of the FANG stocks. Any reversal in these stocks could alone drive the index down into correction, which is really important to keep in mind for index ETF investors. And there are some things looming that could impact those big companies, which we'll get to in a minute. But first, number 2, the effect of the Delta strain on the pandemic. So the pandemic has been the biggest factor on the markets by far over the past year and a half. And that's not going away anytime soon. There's still a lot of uncertainty with it. One thing is the impact on the travel industry with the Delta variant is that it's now leading to lower forecasts. In fact, United Airlines, Delta, and Southwest have all issued third quarter earnings warnings. And MGM Resorts told investors last week that its cancellations are picking up. Now, at the beginning of the video, one headline talked about the ICE scenario. Now, this is where there could be a sharp reversal of the post-lockdown overconsumption binge, which could slow earnings. Basically, this is where the pent-up demand dissipates. And then, of course, there are worries that new variants of the virus could bypass vaccines, leading to more restrictions again. And then one more thing is that with the supply chain issues continuing and implementation of vaccine mandates and testing on the labor force, these are things that are leading to higher costs for these companies, which will either hurt their earnings or they'll need to pass on to consumers. Which brings us to number 3, inflation and potential moves by the central banks such as the Federal Reserve in the US to exit pandemic-era stimulus programs. This actually is referenced in the FIRE scenario, where the Morgan Stanley analyst says that a booming economy with sustained inflation pushes the Federal Reserve to raise interest rates, which could then take the steam out of the stock market. And with interest rates being at historical lows, there's no way that these rates aren't going to go up eventually. And when that happens, those technology-based growth stocks that everybody has done so well with that use debt to fuel their growth will be negatively impacted. At this point, investors aren't expecting any news on the Fed taper of buying assets until November at the earliest, and then interest rates being raised down the road. But of course, any surprises in economic indicators for inflation or in labor could force a speed above the timeline that would likely spook investors. So those are the three main reasons why analysts are predicting for a correction. Now there are some other things out there to be aware of, but in my mind probably aren't as big factors. One is that September is shown to be the worst month of the year for stocks over the past 2 decades. Now one thing this bull market has shown us is that past trends have been thrown out the window, so while I think it's something to consider, particularly since the S&P 500 has seen 7 consecutive months of gains, the longest since 2018, that alone is not a reason that I think a correction is imminent, possibly a pullback, but not necessarily a correction. Another reason that could factor into an impending correction is politics, particularly the political debate on tax increases. Now there's always debate on how much this really impacts the market in the long run, but there's no guarantee that a tight Congress gets this together and that there's any immediate impact. Plus in the current discussion, any negative potential tax increase on the market could be countered with more government spending to spur the market forward. At this point there's a lot of talk, but again, with the Democratic Party's margins in Congress being razor thin, there's probably more watering coming down in these proposals. The other political issue is regulation. Now, there always seems to be an interest from both parties to want to rein in the Facebooks and Googles of the world. If some type of legislation was put together that did impact them, you could see those stocks dropping, which with their market cap weights would pull the index down. But again, you have to consider if Congress could ever get their act together to actually produce something that could be supported by both parties that would actually do this. And to me, that seems unlikely at this time. And of course, the other thing is just that being aware that corrections happen. They always do, and you should expect them if you're an investor. And they're pretty frequent, usually once every year and a half or so on average. Now when they do happen, no doubt they can hurt. And if you just started investing during the pandemic and look at all of those historical charts and think that the market always goes up, you might feel a little different when you see your portfolio taking its first big drop. So realizing that, you might want to start thinking about how to prepare for a correction, whether it comes sooner or later. So let's look at some strategies for investing when you think a market correction is imminent or is actually happening. Number 1, diversification. We hear it all the time, but when you look at the different sectors' performance, like technology versus energy over the past decade, it's real easy to get complacent and say you're going to ride tech all the way. And even if you started with a diversified portfolio, it can get out of whack pretty quickly, so it could be time to reallocate your investments to your original plan. Now it's a lot easier to do this in your tax advantage accounts like retirement plans where you don't have to worry about capital gains for the year. If you would be opening yourself up to capital gains in taxable accounts, instead of selling those stocks, you could just consider putting new money into other sectors or assets which could help you get back on track over time. Now as far as how or where to diversify, you can diversify into different sectors within stocks such as consumer staples or utilities, things that don't tend to have the big upsides but also don't have the big downsides because people need them regardless of economic conditions. I mean, you always need toothpaste, but you might be able to put off that new iPhone or sporty convertible. The other thing is that these companies are ones that tend to be profitable and often offer dividends which could temper any declines in the stock price. Now obviously you could also diversify into different asset classes like bonds, real estate, or crypto. Now this would be more dependent on your comfort and awareness of those classes because there's no guarantee that they wouldn't even be more volatile. Something else to consider is if you have debts, particularly high interest ones, now might be a good time to pay those off. It's not as exciting as making money, but pretty much nothing else beats being debt-free when it comes to financial wellness. And even if that correction doesn't happen, you'll still be better off for making that move. The second thing is just be ready and have some cash on hand so that if the market does drop, you have some money ready to buy stocks at some lower prices. To get this money, one thing you could do is to take some profits from stocks that have done well for you, but ones you might feel could be at risk if a correction were to happen. You could also divert new investments into cash accessible accounts like a money market fund. Now, obviously the risk in this strategy is that there is no 100% certainty that a correction will happen, but there's always an opportunity to buy when the market drops, so I always have some money ready for a downturn. whether for an individual stock or for the entire market, particularly when the markets are setting all-time highs as they have been recently. There's nothing like buying stock at a discount. Plus, the other thing is, having some money on the side can act like a buffer for any big downturn that would keep me from feeling like I became financially strapped overnight. The third strategy is do not panic sell. With money you don't need now or in the near future, you're more likely than not to capture your losses and lose out when the market rebounds, which, like a correction, is really hard to predict. Now, this doesn't mean you can't sell or shouldn't sell, it just means don't sell because emotions are telling you to. You should only sell because you are following a plan you made when you were in a rational state of mind. Number 4, for money you're going to need in the near term, move it somewhere safer. You should do that anyway, whether you're expecting a market correction or not. If you're looking to buy a car or a house in the next few months, take the money out of riskier investments so that you can protect the principal so it's definitely there when you need it. Now, if you're close to retirement, you should already have been moving some of your money to safer options, although with life expectancies getting longer, you still want to keep some portion earmarked for higher growth by being in some of the more aggressive mutual funds or ETFs. And along with diversification, maybe the best strategy is to do nothing. What? Yep, do nothing. It could be the best thing you do. The key here is to look at your timeline. If you aren't needing the money for years or decades if you're younger, it might be best just to weather the storm. Over time, while there's no 100% guarantee, history shows us that the market goes up, so keep up with your plan. Invest steadily and consistently. Tortoise and the hare. There's not much worse than taking money out of the market that you don't need and then missing out on positive returns, which, like corrections, are also hard to predict. And that's really hard to stomach. So in a lot of cases, sometimes it's best just to sit tight. So there you go. I hope this video helped you better understand why we're seeing more warnings of a market correction happening, and what you can do to best prepare for one. If you enjoy videos like this, please remember to push the like button and to subscribe to the channel if you haven't already. And if you're interested in non-financial types of videos where I share ways to save money and complete lots of different DIY projects and tutorials, check out my brand new channel, How To with Kevin. I'll link it for you in the description. Thanks so much for watching, and I will talk to you soon. Take care.